At just 19 years old, Jack Rosenthal manages a $100,000 investment fund. He started an investing club for teens in high school, and today he directs the capital of about 100 of his peers. But his aggressive move into the markets is actually the new normal. Right now, over half of Generation Z adults hold some form of investment asset, from stocks to mutual funds. For decades, building wealth this early was nearly impossible. Investing operated as a closed loop, restricted by age minimums, high capital requirements, and the need for traditional human brokers. This chart shows the severe gap between participation and comprehension. While 26% of Gen Z is directly invested in the stock market, only 1 in 4 feels they understand market mechanics well enough to actually explain them to a friend. Millions of young adults are executing real trades and buying volatile assets without knowing the basic mechanics of what they are purchasing, creating a dangerous and largely invisible knowledge gap. This aggressive push into the markets didn't happen in a vacuum. This cohort grew up watching their parents struggle with the crushing weight of mortgages, credit cards, and the fallout of major financial crises. Then, just as they were entering the workforce to build their own stability, the global economy abruptly shut down. According to the ADP Research Institute, 39% of Gen Z faced a job loss, temporary layoff, or furlough during the pandemic. That early career trauma is compounded by a deep skepticism about the future. Nearly half of Gen Z adults believe that safety nets like Social Security will completely disappear by the time they reach retirement age. Combine an inherited fear of debt, sudden job losses, and a vanishing safety net, you forge a generation that feels a desperate, urgent need to achieve financial independence entirely on their own. To satisfy that urgency, they turn to the tool they know best. Young adults spend an average of 6.5 hours a day on their smartphones, heavily relying on YouTube and TikTok as their primary classrooms for personal finance. The portfolios born from these algorithms are full of contradictions. About a quarter of Gen Z investors hold cryptocurrencies and stocks, yet they rank cryptocurrency dead last on their list of understood financial topics. Social media constantly feeds them overnight success stories. Watching peers rapidly generate wealth creates intense anxiety about missing out, pushing young investors to take uncalculated risks and overextend their capital. They are highly confident when it comes to tracking daily spending and saving on smartphone apps. But when asked about structural realities, like managing credit scores and handling debt, nearly a third admit they only have a beginner's grasp. Despite holding complex digital assets, the #1 financial skill Gen Z wants to learn is filing taxes. The gig economy means young earners deal with complicated self-employment tax scenarios simple apps aren't designed to handle. The digital feed has successfully motivated millions to start investing, but it has left them entirely exposed to the dense structural mechanics of finance that actually protect wealth long-term. Social media has undeniably democratized access to financial information. Tactics and data that were once locked behind expensive wealth management paywalls are now freely available to anyone with a phone. But there's zero professional curation. A charismatic creator giving advice on TikTok is not bound by any credential requirements, nor do they owe their viewers a fiduciary duty, a legal obligation to act in your best financial interest. Absorbing a massive volume of surface-level video content creates a false sense of security. Viewers feel like they are receiving a deep education, when really they are just collecting loose facts without a cohesive framework. You can type any financial term into a search engine and get an instant definition. But a search engine cannot synthesize a personalized financial plan that accounts for your specific income, long-term goals, and tolerance for risk. To survive the volatility of modern markets, young investors have to do the one thing their digital feeds are designed to prevent. They have to slow down. Moving from algorithmic enthusiasm to real foundational literacy is the only reliable way to secure the independence they are chasing.